By sanctioning China, the US would make a terrible mistake. In today's video, we will discuss the possibility of the United States imposing sanctions on China and the potential consequences of such a move. The US has already imposed tax sanctions on China, targeting their access to American-made chips and chip-making technology. However, the US has a more potent weapon in its arsenal: the ability to weaponize the US dollar against China. To fully understand the implications of this potential move, we must first examine the motives behind it and the current state of affairs between the US and China. The US has spent an enormous amount of money supporting Ukraine, which has caused a terrible inflation wave. The US has already imposed over 10,000 sanctions on Russia, making it the most sanctioned country on the planet. However, Russia's economy is vastly different from China's, as Russia is a commodity giant and a nuclear power, while China's influence and economic power far exceed Russia's. Therefore, sanctioning China is a whole different story, as their economy is 10 times larger than that of Russia and their banking sector is 30 times larger. However, the US is discussing possible sanctions on China with the G7, with Olaf Scholz warning China of consequences if they supply Russia with arms. This escalation point puts the US dangerously close to an economic war with the world's second largest economy. The global economy would become collateral damage, with the pieces already being set up in motion. So, why is the US looking to sanction China? Is it truly due to the fear of China supplying Russia with arms? We must understand the financial motivations behind this. The US has spent an enormous amount of money supporting Ukraine, with at least $76 billion in funding, of which over $46 billion has gone into military aid alone. The US is expected to provide funding to Ukraine well beyond 2030. So, how much more money can the West keep sending? If China sends in arms, this will prolong the conflict and cause the West to bleed out more treasure while keeping inflation high. However, if the US weaponizes the dollar against China, especially against the world's second largest economy, it could backfire badly. Although China would be hurt economically, another global inflation crisis would occur, and the true victim would be the US dollar. If the G7 punishes China, many countries will close ranks with China. China has built many alliances and economic ties with the rest of the world, so if the world could circumvent Russian sanctions, they would undoubtedly find a way to trade with China. Furthermore, China has accumulated a lot of soft power since the Belt and Road Initiative, becoming the largest lender to emerging market countries, 2 times more than all other Western governments combined. This means China has a lot of financial and social capital spread across the world. If the US sanctions China and cuts them away from the dollar system, the war will be affected, and many countries will close ranks with China. China is building influence in the Middle East by forging peace between former rivals, Iran and Saudi Arabia. They have agreed to end years of hostilities, something the US hasn't been able to accomplish for decades. China is all about business, securing their partnerships with big oil producers. This is a significant factor as to why the dollar sanctions will not be very effective. If the US were to freeze all of China's assets, including their treasury holdings of over $860 billion, it would cost a lot of short-term pain. However, China's economy would not collapse, as they are still moving nearly $3.2 trillion in forex reserves. Even if the US takes away the $860 billion, it would only be a 26% hit to China's reserves and not a crippling blow. While it would be a short-term financial victory for the US, they can take that money and keep it locked up in US treasuries, which would help to prop up US bond prices and keep yields low, especially with the Federal Reserve still on its rate hikes campaign. However, if the Global South sees China's assets getting confiscated, they may dump US bonds, which could cause highly leveraged banks in America to collapse. It isn't impossible that China's treasuries could get frozen as part of the sanctions package, as happened to Russia before. While China's loss will be America's gain, that is only in the short term. The majority of China's money is away from American shores, with a gold position of over $125 billion, and they have a total position of over $3.3 trillion in their reserves with the IMF. So, how will China manage yuan without dollars? The traditional method China uses to keep their currency competitive is to sell off the Chinese yuan to buy up US dollars. However, if the US uses the dollar system as a weapon, China faces a dual problem right now. Firstly, getting dollars from American trade will be harder. And secondly, even if they manage to buy dollars, they cannot put them into treasuries to gain yield anymore. Additionally, the Western world, including the G7, may choose not to accept dollars coming from China. China's huge banking and trade network could be utilized to cope with the potential consequences of a U.S. sanction on the country. While China holds a significant amount of dollar reserves, it could still use its in-house forex reserves to keep the yuan suppressed and continue to buy domestic gold using the yuan. This would help to keep exports competitive while also reducing demand for dollars. If the U.S. was successful in blacklisting China, it could result in significant trade damage to both sides, with China losing over $1.4 trillion worth of trade and the G7 collectively losing over $700 billion worth of business from Chinese imports. However, the Council of Foreign Relations points out that U.S. companies have benefited immensely from trade with China, with over 2 million jobs supported by exports to China. If the West were to cut China off from their financial system, it would play into Beijing's hands, and the result could be a galactic West versus the global South. The possibility of a new common currency being pushed forward by the BRICS nations or even more central banks buying gold to protect their assets from chaos is also discussed. China's exporters would reduce their dollar exposure, and there would be fewer dollars needed to trade with China. This could have a snowball effect that could eventually hit the U.S. Treasury market, causing bond values to crash and yields to stay high. The U.S. would face a debt default crisis, seriously damaging the dollar's reputation. Punishing China could lead to a split in the world between the dollar system and its capital markets versus commodity giants and their manufacturing power. If countries start offloading their pile of dollars, it could result in a deadly effect where the U.S. is flooded with dollars, causing prices to rise domestically and leading to yet another inflation crisis. The only winner in this scenario could be gold. If you have any thoughts, opinions, or questions about the topic, please share them in the comments below. Your feedback is always appreciated and helps us create more informative content. Don't forget to hit that subscribe button and turn on notifications to stay up to date with our latest videos. We cover a range of topics related to finance, economics, and current events that you don't want to miss. Thank you for your support. We'll see you in the next video.